Thank you so much for those kind words, Ros. One of my first experiences when I arrived in Ireland 8 years ago was coming to a society meeting. And I was just moved by the number of people that came up to shake me by the hand and welcome me to Ireland. And I can't say how important that was to me and how much that meant. It's been absolutely lovely. You guys have been so kind to me. And I'm absolutely thrilled when Brian called me up and mentioned this honorary. I've actually put it on the slide, although it's probably not technically true until you've handed me the parchment.
No, I think it is actually. It's from the data council, because actually when you see the date on it, I think you've been there since about, I can't remember the date actually, but it's a couple of months ago anyway.
Okay, well I'm pleased to hear that. And similarly, the PhD, I don't actually have the certificate yet. But I'm told I can use that for the time being. So I'm happy to take questions anyway through this. There's some technical stuff and some non-technical stuff. And if I don't get through everything, that is absolutely fine if you have more interesting things to talk about. So I'll tell you what I plan to say, and then you can decide whether that's what you actually want to hear. Oh, a bit bright, sorry, let me get here. So to start off with, I had to show you this wheel, which is familiar to all the actuaries here. So we're going to be looking at data analysis, modelling, risk management, a bit of judgment, and a bit of functional expertise, but not too much. So when you need to tick off your CPD form, are these slides going to get uploaded? I don't know. Yeah, okay, good. So you can keep your CPD records. So on to my main topic. I'm going to say a few words about normal distributions. And then I'm going to say things about the alternatives. What can you do instead? What is done instead in actuarial works? And the big theme there is that once you're away from the security of a distribution that we all know, there's this enormous variety of different things that have been tried. And so you want to know, does it make any difference? That's a bit of a technical stuff. And then I'm going to look at some areas. Well, I say this changes everything. So these are theories that we all use, most of us, day in, day out. And there's some way normal distributions underpin it. So the question is, if you take away the normal distribution, does the whole thing collapse like a house of cards? Is there any way you can fix it? Is there a sort of a cliff edge? If assumption doesn't hold exactly, then the whole model is worthless. So I'm going to say a little bit about that. And then if I get there, I'll get to conclusions. But the conclusion will happen at 6:30, regardless of whether I am on the conclusion slide. Okay. If you have any questions at all, I'm going to stop. But I do need to ask you, please, to wait for the microphone to come, because the questions are being recorded. Otherwise, my answers would make no sense. They may make no sense. So a bit of history. This is Carl Friedrich Gauss, and just over 200 years ago, he proposed this thing called a normal distribution, which all the actuaries in this room are probably familiar with. You count numbers of standard deviations away from the origin, and you've got about a third chance of being each side of the origin. But as you go away from the origin, your chances decrease very quickly. So you don't get many outliers. You don't get many things that are very far away from the middle. And the normal distribution is used in loads and loads of actuarial topics. We'll come to some of them, partly because it's convenient, not necessarily because it's right. So we're going to try and understand, well, what could you do to make it more, or does it matter? So I've got a little story here, which is actually slightly embarrassing, but I feel you'd learn so much from it that it's worth my embarrassment. Here is an Irish stock market index. Here's some history. And what has this got to do with normal distributions? Well, analysts look at changes in stock market levels. Technically, they take logs first. And they do histograms of that, and it looks kind of bell-shaped. But when you go into a bit more detail, it doesn't look quite so bell-shaped. So what I've got here, I've got about 6,000 days of data here, 30 years, 250 or so trading days a year, so slightly more than 6,000 points. I've looked at changes over 1 week periods. So I've got 6,000 numbers because I'm allowing them to overlap. And I've sorted them from the smallest to the largest. I then took 6,000 observations from a normal distribution, and I sorted them from the smallest to the largest. Okay, so if these changes came from a normal distribution, that plot should be a straight line. It's called a QQ plot. Here it is. If I can make the... no! Oh, there we are. So along this axis, I've got the quantiles for normal distribution somewhere around here. Here's the upper quartile, there's the median. And here is the same quantile sorted from the from the observed distribution of returns. If the returns were from a normal distribution, that would be a straight line. And it doesn't look much like a straight line, but that's a bit of an optical illusion because there's actually the vast majority of points lie in this middle area. So if you're interested in describing in 7-day returns, apart from a few obscure things that went strange, then you could be okay using the middle of that curve. But if you're interested in the extremes, if you're interested in solvency, you're interested in the very good news, then you do have to think a bit more about what's going on in those corners. So I'm going to tell you a bit about how to do that. So here is the embarrassing story. So I used to work for a consulting firm. We sold economic scenario generators, and these were bits of software that generated forecasts of stock markets, and you get 1,000 scenarios for a few grand. And they were great scenario generators. So in the 90s, people had simple models based on normal distributions. You made them independent from one week to the next. You add up all the returns over a 1-year period, you get the return at the end of the year, and there is a theorem that says you add up normals, you get another normal. And I thought I can do better than that. And I found some distribution which had these fat tails, these a bit better in the tails, and so I built models from that, and I built lots of independent weekly models, and I got my employer to sponsor me, to pay me to develop this, and it took a little while, and I did lots of data, and I fitted it, and out came a model. And I fitted these weekly data, and at the end of it, I got theoretically, this normal inverse Gauss distribution. But what I discovered when I played with these scenarios was that there was no question to which my new model gave a different answer to the old one. Okay, so I had gone to a large amount of effort to build something which on paper was better. But actually, for the clients who might be using it, it wasn't really changing their decisions. So I had a colleague who sat down to me and said something along the lines of, "You idiot, who is going to pay for this?" But it turned out to be very popular. And the reason it turned out to be very popular was that our clients, the insurance companies and pension schemes, they had regulators and rating agencies breathing down their necks saying, "What are you doing about these distributions, right? These fat-tailed non-normal distributions." It wasn't just me who spotted it. It was sort of common knowledge. And it was sort of common knowledge that the established models didn't cater for it. So what they wanted to do was two things. Firstly, for you to tick the box. And second, for the answer not to change. Okay, so that was a selling point. But that brings me to a general theme of you can do things in a very much cleverer way, but you want to know how the answer changes. And ideally, you want to know how the answer will change before you spend 6 months figuring out building the model, because you could end up with something that nobody wants to buy. Incidentally, this idea of adding together lots of little distributions and making another one is something I'm going to call a mean preserving construction. It's a way of getting non-normal distributions, adding totals of smaller non-normals. I'm going to come back to that. So there's this thing called universality, which mathematicians love, and it says that normal distributions pop up all over the place, even with problems where you didn't put normal distributions in to start with. So that's one reason why it's sort of popular. And here, the distribution that came out at the end, the 1-year distribution, was indistinguishable, really. You had to work very hard to see that it was different. So that was a sort of a learning experience for me, and it made me realize that often the question of the impact of a change was important as the theoretical basis for the change. But sometimes it does matter. So the 2007, you may remember those times. Top of the stock market, there was a lot of hubris about actuarial models. And so AIG, they produced an economic capital report. And they said, we have worked out the amount of money that we might lose in a very bad scenario. And we're going to define our bad scenario as a thing that should happen only once every 2,000 years. Okay, so if you think about what's happened in the last 2,000 years, they were claiming to model things of that frequency. And they said that the amount they might lose in the worst of one in 2,000 years will be just under $20 billion. And of course, their conclusion was, well, we're absolutely fine. We've got more than that. And therefore, Mr. Regulator, can you release our capital requirements a bit? And we got 4 consulting firms telling us this model is the greatest thing since sliced bread. Some of them are still in business, so I won't name them. With a bit of Googling, you can find out who they were. So what happened the next year? Well, they managed to lose 99.3 billion. They managed to lose 5 times what they said they might lose in a 1 in 2,000 year event. Okay? So you do the maths and you work out, well, how frequent, according to their model, would this 99.3 billion be? And the answer is it's 1 in 4 times 10 to the power 62 years. So the age of the universe, I think, is thought to be 20 or 30 billion years. Okay, so that's a long time. And that started getting people asking questions about these sort of science fiction percentiles. So I've shown you examples where using the wrong distribution really matters and where it doesn't matter. That's the sort of whet your appetite. Has anybody got a comment or observation you'd like to make before I get? So I'm going to get onto some slightly technical stuff next. No, you're all okay. So what's the alternative? If you're not going to use normal distributions, how are you going to extend it? So I'm going to show one example of an extension, and then I'm going to tell you that there's lots and lots out there, and they're all the same, but not quite. So here is one. So I've got some names here on the left. It's quite difficult to find heights of some people. So some of them I had to watch a video of them next to somebody whose height was on Wikipedia. But this is what you might call the contamination approach. So the contamination approach says, well, there's a normal distribution that covers most of the time, and every now and again, you get something comes along that doesn't come from that distribution. Just sometimes they're called black swan events. So in this case, good old Finn McCool is there at 16 meters tall, and definitely an outlier compared to the distribution of the other people there. And it's all very well knowing that, but with the contamination approach, what do you do with that information? You know, let's suppose that somebody said, I'm an interior designer, and I want to make sure that everybody can come through this door in the Alex Hotel. And somebody says, well, you've got to allow for the possibility that somebody 16 meters tall wants to come in. And of course, that doesn't make any sense. So you'd like to have some sort of probabilistic idea, not just this was some outlier. And you know, the contamination approach makes most sense when you've got a number that's kind of obviously wrong. Maybe something's been not recorded. You know, somebody's date of birth is down as the year 0 because somebody hasn't filled it in. And you want to disregard those. The difficult with financial models is that some of those extreme events, in fact, most of them actually happened. Okay, the stock market crash is something that actually happened. So you don't want to ignore it and say it's a recording error. It is not a recording error. People generally lost money. So what can you do instead? So here I've got something. This is Edmund Cornish, an Australian statistician, and Ronald Fisher, a British statistician, and they came up with this thing called a Cornish-Fisher curve. And what they did was they said, I'm going to get a normal variable, z, and I'm going to, instead of using z, I'm going to use some function of z. And that function I'm going to use is a cubic, and I've shown one of the cubics there. So the advantage of that is you can play with some of these parameters, and you can change this so it looks a bit like that QQ plot that I had from the data. And so this is called a Cornish-Fisher distribution. It's an increasing function, so there's a 50-50 chance of it being above or below 0, just like there's a 50-50 chance of the normal being above or below 0. So it's you call that a median preserving construction. And it's also an example of what they call a Q-linear family, because it's a mixture of, so it's a cubic. If you mix cubics, you get more cubics. That doesn't always happen, but this is a property of the Cornish-Fisher. So that sounds like an idea. Instead of modeling things from a normal distribution, take a normal distribution, shove it through a cubic, and out the end comes something that maybe looks a bit more like the data that you've got. So that sounds like a good idea, but unfortunately it is not the only good idea in town. I've spent some of the last few years finding out other approaches, and the problem is there's loads of them. Oh, sorry, before I get there, this is the picture of the density of a Cornish-Fisher distribution. So you've got some fatter tails, you've got a mode which is bigger than the median, you've got a mean somewhere here. The median is 0, same as the normal. It looks quite different, and that's an exaggerated version of what we see in lots of financial data. So you can fiddle around with the coefficients of the cubic. Instead of using this, I could make it look more like the data, but it would be less visible. So that's one idea. And you look at that and you think, that makes perfect sense. I could do that. Problem is, there's lots of ideas. So every one of these little smarties is a paper that's out there from somebody saying, I know what to do instead of a normal distribution. You should do X. And so there's this big literature. I've talked about mean preserving constructions, so that's all the ones in this little set. Median preserving, things like, there's my CF3. Here's a normal inverse Gaussian, my embarrassing story from 30 years ago. There are mode-preserving transformations, where you take a density and raise it to a power. All these different ways. And there was a time when the best way to get a paper published in an academic journal was to invent a new distribution. And so there was an industry in creating these things. But it leaves you with a bit of a bother as a practitioner. How on earth do you choose between these large numbers of alternative approaches? So I'm going to show you something which is a bit... So here we are. So Benoit Mandelbrot had an idea. Benoit Mandelbrot is mostly famous for the Mandelbrot set, which makes the cover of lots of coffee table books. But he also did a lot of work on financial modelling, and he was the first to use one of these things, this dark red Lévy-Stables distribution, so a non-normal class. And he classified all of these approaches. And he said there's some of these approaches using normal distributions is mild randomness. And mild randomness is associated with these thin tails. And up here we've got really wild things. Now don't worry too much about the definitions of those, but an example of wild distributions, I showed you that distribution of people's heights, and you said that Finn McGall is probably wasn't actually that high and may in fact only not existed. But if I did it with people's income, it's quite possible there's somebody here who earns 10 times what I do. In fact, I earned in my old job 10 times what I do now, because I was partner in a consulting firm. So that could happen. So that sort of fluctuation would be a wilder distribution. You get some very, very large observations. So Mandelbrot had that classification, and I've color-coded in this picture his classifications. That gives you some idea of understanding what your choice might have made. But it's not that simple. So here's some questions. Does it matter if I use a normal for, and I'm looking here at value at risk, those numbers that AIG was producing. Does it matter if I use a normal or something else? And the answer is yes, it does. The normal is going to understate your riskiness compared to pretty much any other sensible model. Does it matter which of the 16 families I pick? Now, this is actually a really hard problem because you don't have software for any of them. You have to do a load of coding. You have to invest months of time to implement one of them. So I have a student, CJ, and she did a load of work on which one? The JSU. And that was a one-year project. Okay, so there's a lot of work to be able to implement these things. So it's a bit frustrating. What difference does it make? Well, I don't know till I've implemented them. How long is that going to take me? 16 years. So the tentative answer from the experiments I've done is that most of these produce pretty much the same answer, but one of them doesn't. So a couple of them don't. So the Lévy-Stable that Mandelbrot liked doesn't. And this one is one I constructed just to show that they don't all have to fit. And it's hard to do the comparison because it's not just a function of the model you're fitting, but what data set have you got, how are you fitting it, and there's all these numerical approximations because they're really, really messy to implement. So the difficulty for you, as somebody who might be using one of these tools, is you kind of want to know how it's going to affect the answer, but you don't know until you put in a load of development work. So when I was at my previous consulting firm, I put a load of development work on this one. And it so happened that I could piggyback off some tools that were already in Excel. It quickly became a standard for Solvency II internal models, for no better reason than it was coded in Excel and therefore easy to implement. So implementation matters. It became a standard, and once a few firms had done it and got their internal model approved, then the fact the regulator had approved somebody using it meant that somebody else found it easier, and that became a path of least resistance. So that is the true story, not the one we told at the time, as to why this was the best approach. So these confounding things. So I'm going to try and explain to you, and this is where it gets a bit mathsy, but forgive me, because the mathsy will go away after a couple of slides, and then you'll be back into proper rhetoric, okay? But for those of you who like the mathsy, I will show you a bit of the mathsy bits. So, showed you a QQ plot. I showed you one QQ plot. Actually, I've shown you two. I've shown you one for the Cornish fish, and I've shown you one for data. Don't think of a QQ plot as a chart now. Think of a QQ plot as one point in an infinite dimensional space of QQ plots. Okay? So a family of distributions is a locus of points, and it's actually a four-dimensional surface because these are four-parameter families. So every family of distributions, every one of those little smarties, is a four-dimensional thing called a manifold because they're not flat, most of them, they're curved. The ones that are flat are CF3 Anelli, which has this thing like cubics being, averages of cubics still being cubics. Most of them don't have that property. Okay, so I've got 16 curved manifolds, and I'm trying to understand how the choice of the manifold affects the answer to some question I might ask. So what I'm going to do for each of these manifolds, they all have the normal on them. They all have the normal as a special case. So I'm going to look in the neighbourhood of the normal, and I'm going to take a tangent plane. So you know what a tangent plane looks like on a sphere. You have to imagine now you've got a four-dimensional curved manifold, and you're looking for a tangent plane to that, which is now a four-dimensional flat thing, a four-dimensional linear manifold. So your tangent space is also a Q-linear family of distributions. And you can do this analytically, so you don't have to do so much coding. You can do it analytically for all those families. And what I found was that all 16 families, except for these two, have the same tangent space at the normal. Now that was completely unexpected. Each one was sort of several months of doing analysis, trying to work out how to solve those equations, working out you could do it analytically. So essentially, of these 16 families, derived by different ways, built by different methods, classified differently by Mandelbrot, 14 of them are very similar to each other. And the other two are not. Levy stable, nobody uses. I tried using it, the response from the client was, "Are you kidding me?" Okay, because the numbers come out so big. It tells everybody, however much money you've got is not enough. It's not a message that anybody wants to hear. So I can show you another picture. This is attempting, so this is a two-dimensional slice through infinite dimensional space. And each of these curves now is one of my families, one of my little Smarties. So two of those families were linear spaces, the Cornish-Fisher and this Nelly thing. Some of them, quite a few of them, went through the exponential distribution as well as the normal. And the point is here that all of them, except for the Nelly and the Levy stable, are tangents in the neighbourhood of the normal. Okay, so if you've got something which is close to being normal, like most financial data is, but not exactly there, then it kind of doesn't matter which of these families you use. Okay, and I got that by talking to various colleagues, and one of them eventually said to me, "I think that is a problem not in statistics, but in differential geometry. Let me tell you about differential geometry. And in a university, you can do that. If I want to find somebody who understands IORPS or Solvency II, I'm struggling, but I can find people who understand differential geometry. So learn another bit of maths, do a bit of differential geometry. And that was my explanation. This is why all of these ones bunch together and why these two are outliers. Okay, so that's useful to know because it helps me to predict. It says, well, I'm not going to invest a huge amount in building models which are very similar to each other. The differences very rarely matter. Does anybody want a question on that? Has that really just knocked you? It does get easier. Nothing at all. Well, you're going to get to your canapes very early. Okay, so I'll keep going. What I'm going to look at now is some of the arguments where, so if you're doing value at risk calculations like I showed you there, it's sort of plug and play. You had a normal distribution, it wasn't quite right, you found something that was a bit better and you replaced it. But there are some things like portfolio selection or hypothesis testing where normal distributions are so embedded in what you do that things sort of fall off a cliff if you change it. So I'm going to talk about some of those now. So here's something that any of my students will be familiar with. This is choosing an investment portfolio. And on the right-hand side, you're going to choose between different portfolios. My blue dots represent 3 different portfolios, 3 different mixtures of assets. And they've got a standard deviation of return and they've got a mean return. And you want to have a mean return that's high and a standard deviation that's small, so you're maximizing your risk and minimizing your return. There'll be lots of portfolios here, and you don't want to have any of those. And I've found some distributions which replicate those blues. They're not normal. They are symmetric. They're just 50-50 of up or down or whatever. And a lot of, I'm not sure Tony is here yet, but Tony Gilhawley has done a huge amount of work on getting appropriate products for customers. And this is a key part of it. If you go to a financial advisor, what they do is they try to find out how risk averse are you. Are you the sort of person that goes skydiving at the weekends? Or are you the person that sticks your stamps in your stamp collection? And they work out how high risk. They don't actually ask that. They ask you about financial things. And if you're risk tolerant, you're going to be up here with your high risk, high return portfolio. If you're very risk averse, you're going to be down here. And if you're in the middle, you're going to be there. So this idea of eliciting from people, how tolerant are you of risk? So there isn't a right amount of risk tolerance. I couldn't come to any of you and say you are too risk tolerant. That is entirely your personal preference, just like whether you like Marmite or not. Okay, there's no financial theory that tells you how risk tolerant you have to be. So you could end up, different one of us, with these different blue points. And so far, so good. If I'm dealing with normal distributions, I've only got these two axes. I've got to worry about risk and return, and it kind of doesn't matter how I measure risk. I could do it with standard deviation. I could do it by probability of not being able to fund the school fees that I'm saving for, or not being able to pay my pension, or whatever it is. All of them will essentially get the same ranking from low risk to high risk. And we sort of know how to elicit that. We don't always get it right, but we have some idea of how to elicit that from people. So here I've got a messy distribution. It's a left skewed distribution, and this has the same expected return as the medium risk blue. It has a slightly lower standard deviation. So you might say, well, that's better, right? It's good. If I can reduce the standard deviation and keep the mean the same, that's better. That's an improvement. But the problem is that this thing is very skewed. My worst case here is a 14% loss, whereas my worst case here is a 6% loss. So if I look at worst case, I get a different ranking. If I look at worst case, this looks like it's more risky. But if I look at standard deviation, it looks like it's less risky. So you can construct these examples. And the problem is not, I can do the econometrics and work out whether distributions are skewed, but how on earth do I work out which people should prefer? So researchers do that. They go around university campuses with clipboards, and they give these people, would you rather be a hammer or a nail sort of questions. And they give them scenarios, and you can have with this probability, and that with that probability. But I guess that most of you, looking at the red one and this medium risk, you'll be hard-pressed to say which you prefer. And I'm talking to a room full of actuaries who understand probability. Okay, so you can go this route of modeling things in more detail and getting a better measure of distributions. But when you come to make decisions, it comes down to personal preferences, and those are almost impossible to elicit. We haven't found a good way of doing that. So you're in the position of having a statistically better model, but it's not actually much more use, because what you want to do with it, you can't do. We only really know how to ask questions about high, medium, and low risk. We don't understand whether it will make somebody happier or not to move them from that distribution to that distribution. There's no theoretical answer to that. They could have a different utility function. So it gets, I'm going to talk now a little bit about option pricing, and forgive me if you haven't come across option pricing. I'm not going to explain it from the bottom up. And I give you a picture. So this is a very general economic equilibrium construction, which academics love and practitioners almost never use. But I'll take you through how it works. So if I didn't have to worry about calibrating people's preferences, I could start off with my probability model, and I do some time series analysis. I fit some distributions and outcomes to my model of what's going to happen in the future. And then I have to describe preferences. So I have to work out how people make choices. And that's really difficult. But I can write down formulas. As an academic, I can publish papers that say, well, here's a way of choosing which seems fairly rational. Let's see what happens. And when I do that, I get some portfolios that somebody's chosen. If I can replicate that for all the investors, I can guess all of their preferences. Then I can add together their portfolios, and I get all the asset demands. How much shares are people trying to hold? How much bonds? How much property? And I compare that to the number of shares that exist and the number of buildings, investable buildings that exist, and the number of overseas assets and so on. Okay, so the economic equilibrium, what academics try to do is they try to make these things consistent. So you either say, what would people's preferences have to be given this probability model in order to account for all the assets that exist? Or alternatively, if I take the preferences as given, what does that tell me about the relative returns on different assets? That's sometimes called the Black-Litterman approach. So you're kind of working backwards, trying to get a consistent picture of all these things at once. And there's nothing stopping you doing that if you don't have normal distributions. It's just a bit fiddlier. Okay, but here I've got to estimate these preferences. And this is the Achilles heel of the approach, that we just empirically, that's very difficult to do. I can prove formulas, but I can't actually work out what numbers to put in the formulas. And then somewhere along the way, as a spin-off, up comes ways you can price financial derivatives. Okay, so in the general sense, to work out at what price some financial structure, maybe a guarantee embedded in an insurance policy or an equity release mortgage or something like that, to work out the value at which it trades, I've got to work out who might invest in it, how it would change their portfolio, and how much you'd have to pay them, how much they'd have to pay you to get that extra bit of asset. Okay, so that's the framework that we as academics look at. And I say it's almost never used by practitioners because of not being able to calibrate this bit. So what do practitioners do instead? Well, it turns out that with normal distributions, everything simplifies. So here's a few famous people. So Fisher Black and Robert Merton, Myron Scholes and Robert Merton shared a Nobel Prize for these insights. Fisher Black only missed out because he died before they awarded the Nobel Prize, and they don't award them posthumously. But these three American economists figured out that if you build models from normal distributions, they have these continuous paths. And if they have continuous paths, then you can do this thing called dynamic hedging, where you're continuously buying and selling, and you can continually hedge your exposure to things moving in unexpected ways, and you can replicate options, and you get this wonderful option pricing formula. Okay, so many, many years ago, I was trying to get actuaries interested in Black-Scholes option pricing formulas at a time when actuaries were using something quite different that I didn't think was as good. But there is an Achilles heel here that all of these rely on normal distributions. And so Norbert Wiener figured out that you do actually get continuous paths if you build them from normal distributions. Paul Levy came along, the same guy as the Levy's table, and he proved that the only way you're going to get continuous paths is building from normal distributions. If you change from normal distributions to something else, then you get jumps, and then you're hedging, your replication argument doesn't work. Okay, so you sort of fall off a cliff edge. Only normal works. If you change it slightly, all of those arguments don't work anymore. So this is more of a challenge, isn't it? Because you can't just tweak what you're doing to allow for this effect. So here is my take on this. So statistical fitting of fat tail distributions. It looked complicated. You had to choose between all those smarties. We have some idea of which smarties give which sort of answers, and there's more work to be done and so on, but that is a problem that we sort of can get our arms around. Calibrating investor preferences, yuck. And it's not just for me. I might just about be able to write down my own preferences in terms of integrals and utility functions, but could I write down yours? Could I write down somebody who doesn't know how to multiply two numbers, and yet somehow they're still making choices, still become in charge of countries sometimes? So tricky to get this working if you throw away the normal distributions. But if distributions are normal, then all of these complicated calculations, they sort of cancel out. And you can make assumptions about risk premiums and work out what that corresponds to in terms of preferences, but you can get alternative assumptions with different risk premiums and premises, and the option prices are still the same. Okay, so this really hard bit of calibrating investor preferences, you don't have to do anymore if you're prepared to assume normal distributions, but unfortunately that isn't a valid assumption or not. It's totally correct. So here is the way that I think about it. If distributions are near to normal, then the preferences do matter, but not by very much. Okay, so having really bad estimates of people's preferences might be good enough, but I have to put something on the form so that I can press the button and calculate the numbers. Okay, so this is not a world that we as actuaries often articulate that we inhabit. We might use some established models and kind of tweak them a little bit and do implied volatilities, but you could see a path to a sort of satisfactory way of resolving this. It can be done, but it's a lot of work and people aren't doing it right now. I'm going to show one more example of where normals matter. So here's a much longer time series. This goes from 1700. It's a share index published by the Bank of England. They produced this research called a Millennium of Economic Data. You can download, if you want to know the price of corn, you can go back to the Doomsday Book in 1084, whenever it was. So you can see a few things here. So I guess most of you don't remember, but there was a South Sea bubble. So this was about trade with India, and a couple of companies have been given a duopoly on trade with India, and they raised shares, and people couldn't get enough of those shares. And the price went up and up and up and up and up, and actually those were the first two companies to be listed in London, the first two share companies, and the prices massively inflated and then collapsed again. Okay? And that filled part of a story which says that investors can get very irrational and excited about things and bid up the price, and then when reality dawns, that price comes back down again. Okay? And the same thing happened in reverse in the 1970s when we had this great big oil price shock. Share price collapsed. Some of you might remember that. I was in short trousers then. And once again, it seemed that the market had overly panicked at an oil price shock and some political changes in the UK. There was the similar shock in Ireland, but not quite so big. But there were political changes in the UK. But that sort of corrected itself. So that led to the perception, and it's particularly strong among actuaries, which is that markets do this sort of thing regularly. Okay, people get overexcited or people get over pessimistic, and then after some while they correct because reality dawns. And this is what is causing some of the fluctuations in prices. Okay? And now there have been some ideas here. I'm glad Colin is here because I spend a lot of time with Colin talking about this. So if that view of the world were true, if some of this volatility was sort of bogus and caused by people doing stupid stuff, then along come actuaries with profit funds and defined benefit pension schemes, and you sort of smooth this out between generations, and everybody feels they've got a smooth return, and they feel they've got a bit less risk and somebody's looking after them. And you've done that because you know that some of these really big things, everybody else is losing it. So in this 1987, where's that? You can hardly see it now. There-ish. It would have corrected by the year end. This is annual data, so you don't see it. So I was sitting in a room of consulting actuaries, and the markets were panicking, and their pensions clients were calling them up, and they were saying, what on earth are we going to do? The market value of our assets has fallen by 20%, and what the consultants were saying is, don't worry, because the actuarial value of your assets has not changed by 1 cent. And I was scratching my head thinking this is either really, really clever or alternatively it's not. So this is something that people argue about. They still argue about it now. And one of the reasons they argue about it is it's very difficult to test. So what I've done is I have plotted the change in the market 1 year against the change in the market next year. Okay, so what the thesis would be, if this were true, would be that a bad year tends to be followed by a good year, and a good year tends to be followed by a bad year. So I should have sort of a downward slope. So, but equally or here, there just seems to be lots of good years followed by other good years. Okay, so it went up here and it didn't correct. So it's not completely obvious, looking at that data series, whether this excess volatility is real or not. So, time in the early 2000s, 2 Nobel Prize winners, Eugene Farmer and Robert Shiller. There was another guy who was working in a different area. But the interesting thing about this was that Eugene Farmer and Robert Shiller's work flatly contradicted each other. Robert Shiller's thesis was that this market gets overexcited and underexcited, and it tends to jump back to where it should have been. And Eugene Farmer's thesis was that, well, markets, what happened last year doesn't affect what happens next year, and you can't really predict the future from the past. So these two economists, their results flatly contradict each other, and yet they both won Nobel Prizes. So that says, for essentially work that completely disagreed with each other. So that tells you how complicated it is. And so here I've got a picture. These dots are the changes over that 300-year period. Here is the oil shock. You got a collapse, and then it went back up again. So it's negative that year, positive the next year. Here I've got the South Sea bubble, and that's the reverse. You had a high return 1 year. Have I got that the right way around? I have not. I apologise. Those are the wrong way round. So the oil shock is up here. You've got a fall 1 year and a rise the next year. The South Sea bubble was the other way round. You've got a rise 1 year and then a fall the next year. But this doesn't look like a sort of a downward sloping curve, does it? It looks like a blob, kind of Eugene Farmer sort of blob. And there may be some contamination with some exceptional things that happen from some other distribution. Okay, so this is where statisticians get exercised. They say, well, I'm going to work out the slope here, is it negative or not? And if you assume a normal distribution, you end up with a t-test for the slope, and you come up with a conclusion, well, it does look like it's slightly negative. Okay, but that assumes normal distributions, and normal distributions don't produce these things. If you throw away the normal distribution, you're back in the world of what's called non-parametric statistics, and those tests are much weaker. They're much less likely to show you a significant effect. And that's what happens. So this argument, I'm not going to resolve it today. There will be people in this room who side with Robert Shiller. There will be maybe people in this room who side with Eugene Farmer. And to some extent, you're sort of entitled to your own opinion because the data is so conflicting. And I could add data from many numbers of other countries. There have been books published arguing absolutely that this is downward sloping by picking data fairly carefully. There have been equally well books published arguing the reverse. And it comes down to what you think about normal distributions. But then that affects what we as actuaries offer to consumers. Do we say these smoothing things are the greatest thing since sliced bread, it's going to make you a bit less risky and we can control all those risks? Or do we not say that because it isn't true? And I can't tell you whether it's true or not. You need millions of years of data to be able to work out. So we just have to say, and it's easier as an academic than a consultant to say, actually, I don't know the answer to this question. So, got a few conclusions.
That's a fairly strong statement, Andrew, isn't it? Where does that leave us? And
Oops, where are we? Sorry, I need to go backwards.
the other question I'm wondering about is it appropriate to go so far back? You know, when you think how much...
So I'm going to ask you to take the mic, Roz, if you don't mind.
Yeah.
Is there somebody with a mic? You can use this one.
Oh, yeah, that's fair. Like, yeah. When I see these statistical things going back to the 1700s, I'm always wondering if it's too far back. You know, the world just feels like such a different place, you know, even 100 years ago. So if you were to concentrate your analysis on, say, the last 100 years, would you get a different answer?
You would.
Yeah.
So if you concentrate the analysis on the last 100 years, that is essentially what David Wilkie did when he published his stochastic asset model. And he found that there was this reversal effect, and after a bad year, you tended to get a good year. And it was based on a shorter time series. So if your view is that this earlier bit is irrelevant, you get a different conclusion. Okay? So you could hold that view. I can understand that argument. Things are quite different here. You could argue that actually only the last 10 years count. If you look at the value at risk models that investment banks use, risk metrics type stuff, that looks back 5 or so years, sometimes even less for estimating volatilities. So that is a sort of subjective judgment call that you're making. And we're all making it whether you want to or not. I've done something here with a very long time series, and it is remarkable that if you back test the Wilkie model on the previous years going up to 1900, the effect of reversal that you see here, often driven by that one data point, is completely absent in the previous 100 years. So you get a completely different conclusion. So, I mean, yes, you're right, but we shouldn't kid ourselves. So I think one thing that's important is that when we're explaining this, we need to understand the judgments that we've made and what the impact is. And there's a temptation among all of us to say, well, the statistics proves. And that's very rarely the case, because the judgments you made in choosing your data. Does anybody else have a... Would you want to come back on that? Anybody else got an observation? Yes, I'm going to... So do we have a runner? Sorry, Paul, I'm doing your job. There you go.
Thanks, Andrew. Just a very brief comment to say the corollary to Roz's comment is when we are thinking about how we design things for the future, we are probably looking at a future that's very different to the more recent past. So
Yes.
that's an argument using all the data we've got.
So there are some middle ways. There are some reasons why you might think the future will be different from the past in ways that you can sort of understand and modify to allow for those differences. But there are some very pessimistic people, probably more since the last US election, in terms of the future of our planet and whether in 100 years' time it will be habitable or not. So if you're advising somebody in their 20s about saving for their pension, how much weight do you give to the argument? Well, it's completely pointless, because by the time you're 65, the whole place will just be a toxic wasteland. And that is a possible perspective. So you've definitely got to be careful. I'm not saying that's the only possibility, but sadly the likelihood of that event seems to be ramping up a little bit. So you do need to colour those things. And the fact that, I can look at my father. My father had a defined benefit pension plan. He did brilliantly out of it. Okay, he reached the age of 50, so I don't resent this at all because I'm 56. And at the age of 50, he was retired early, but was given a full credit for the years that he hadn't worked up to normal retirement date, retired on an index-linked pension, and at the age of 85, he is still going, collecting on that pension. So he's been retired more years than he worked, and he did very well. But you don't look at that and say that proves defined benefit schemes are a great thing, because some of them aren't in such good shape, and other people have not done quite so well out of them. So you definitely need to be, you're right, you need to think about, well, how might the future be different to the past? But it's difficult for stock markets, because we just understand so few of the drivers. We sort of understand, or most of us, there's some consensus on what drives the temperature of the Earth. I mean, it's hard to analyse. We do have some common understanding of it. We do recognise that it's not suddenly going to go down to pre-industrial levels, because we recognise the mechanism. But there's a lot of actuarial working parties looking at climate change impact on stock markets. And people aren't really sure. Some people are saying, well, there's all these green opportunities, green investments. Other people are saying this is just doom and gloom. Some people are saying all of this growth was driven by mineral extraction, and nobody was measuring the fact that what was left behind has been depleted, and therefore you can't keep doing that. So yeah, those arguments are very germane. It's not just statistics. Anybody else got something you'd like to say? Ah, Tony.
Can I give you a thought experiment? If you suppose, say that index wasn't an index, but actually a demon.
A demon?
A demon, yes. It's a person with its own intelligence. And it's going to look around it and look at what's happening and then make its own decision about how it's going to behave, and in particular how it's been assessed. Is it going to be a big difference whether it's an evil or a good demon?
I think it's fair to say that's a question I hadn't prepared for. Let me say, I'll give you a kind of a bit of a colour on this. So if I go back to these smoothing arguments, and you unpick what's happening when you're doing your actuarial smoothing, and you work out when you're buying and when you're selling. So imagine you're running a defined benefit pension plan. You're using the actuarial funding methods. The market collapses, and you increase your contributions. And following that collapse, you're buying more equities. And if this smoothing theory is right, you're buying them at the bottom and they're going to perform well. Okay, you go in the reverse, you have a wonderful bumper year, you have a contribution holiday, so your pension plan has a net outflow, you're paying benefits, and you're not contributing in, so you're realising assets. And if this theory is right, you're realising assets at the top. Okay, so you could say, well, that's the wonder of an actuarial model, and years of using those auto-regressive actuarial models. Nobody really asked the question, well, who is the other party of this? Who is this person that's coming along and is happy to buy off me at the top and sell to me at the bottom? Nobody answered that question. And you're kind of relying on a rather benign set of philanthropic other investors who are just ready to be the patsy every time you want to trade so that your pension scheme gets a good return. Okay, so once you see it that way, that makes you think a bit harder about how much you want to trust that model. An alternative would be that everybody else is kind of in it only for themselves, but that is kind of what conventional economic theory assumes. It doesn't allow for some of the better parts of our human nature, that we actually don't want to leave the world a worse place than we left it, and we want to help other people, and there's such things as empathy and kindness. Those are abstracted out. So in that sense, those elements of economics might be just a bit harsh. So one of my experiences here, I'm now a trustee of a pension scheme, something I thought would never happen, and I've undergone trustee training, which was also interesting. But the pension scheme that I'm on, the employers genuinely have a paternalistic and considerate attitude to the members of their pension scheme. And many that I dealt with before were sort of a bit tooth and claw. Once somebody's retired and they're no longer on the payroll, they're no longer working for us, why on earth would she do anything that benefits them? We could use the money elsewhere in the business. So that was one example I saw where the me first was going to be wasn't quite right, and in that case the economic theory was assuming that people were too nasty. So the economic theory might assume you've got a massive free rider problem with the environment. Now, I don't want to live on a planet that's burning, but I do want to go and visit my parents who live in England, so I get on Ryanair. And I assume it's going to affect somebody else, and we all do it. Well, you don't all visit my parents, but you get the idea. But actually, there are people who make sacrifices that do benefit others. And that's kind of hard to explain in pure economic theory. So that might be a good side, a bit of upside.
So can I explain a little bit more about what I'm talking about? Because you've got a complicated sort of thing, the economy, and it reacts and responds in different ways. And there's a thing called control theory, which I probably know a lot more about than I can remember from way, way back. And that is basically saying you've got this system, it reacts. And therefore that gives it a certain amount of life quality to it. Maybe it's not actually a demon, but it lives as a certain thing. And if you look at physical systems, an awful lot of physical systems, you construct them, suffer from problems about vibration, resonance. You know, you all done the thing about bridges and people walk over instead and so on. And most of our behavior is pro-cyclical. And therefore that makes me think that most of these, I call them demons again, are actually malevolent. And Murphy's Law really is out to get you.
Thank you.